Welcome back to the Deep Dive. Today we're moving past the noise and jargon of corporate reporting. We're zeroing in on the Q3 2025 earnings for Illumina Inc., that's ticker ILMN. Our mission is pretty straightforward but powerful. We've got this highly structured 5-part analytical framework, and we're going to use it to cut through the confusion in this release. We really want to understand what actually drove performance this quarter and maybe why those headline numbers, well, they might be trying to trick you.
Oh, you couldn't be more right about the deception there. Honestly, if you only glance at the initial reports, you might panic. This headline, GAAP results, they look genuinely alarming, suggesting a catastrophic collapse in profit compared to last year. But that number, it's a total red herring. For this deep dive to be useful for you, we absolutely have to grasp why the gap between the GAAP numbers, that's generally accepted accounting principles, and the non-GAAP operational numbers, why that gap is the single most important story here. It's really the difference between seeing a company in crisis and one that's, executing a brilliant internal efficiency plan.
Okay, yeah, let's definitely unpack that. Let's start with the raw results. Now for slide 1, the at-a-glance scorecard. All right, starting at the top line, revenue. Illumina delivered $1.084 billion. That's actually a modest beat compared to the consensus analyst expectation, which was $1.07 billion. But revenue growth itself was barely there, just plus 0.4%, pretty flat.
Right, almost flat. But the real surprise, and the good kind, was on the earnings side. Non-GAAP diluted earnings per share, that's the measure analysts and management usually focus on for core performance, came in at $1.34.
$1.34.
Yeah, it blew past the $1.16 consensus estimate, by a massive margin, a really strong beat there.
Okay, but here's where that deception you mentioned comes in. Because if you look at the raw GAAP diluted EPS, you'd see it decline dramatically. By a shocking 75.7%. It fell from $4.23 2024 way down to 98 cents in Q3 2025. That huge percentage drop, that's what grabs headlines, isn't it? Causes that panic selling.
Yeah, it's the absolute definition of noise. And to understand that drop, you just have to look back at the prior year period, Q3 2024. That quarter included a non-recurring one-time gain, a big one, $488 million. This was tied to a legal contingency and settlement, basically a positive financial windfall, but totally non-operational. It related to, past acquisition complexity.
Oh, okay. So not related to their day-to-day business performance at all.
Exactly. That $488 million artificially inflated the 2024 profit number, which makes any comparison to this year look terrible on the surface. But when we strip out that noise, which is precisely what non-GAAP accounting is designed to do, the true picture emerges. Non-GAAP diluted EPS actually grew by a very strong 17.5%.
Wow. So a 75% drop versus a 17.5% gain.
That difference right there is why context is absolutely everything when you're reading these earnings reports. You can't just take the first number you see.
That really is a textbook example. Okay, so if revenue was nearly flat, like you said, just 0.4% growth, then that huge 17.5% non-GAAP EPS beat must have come from some kind of internal operational magic, right? What were the core mechanics driving that earnings increase?
Well, our sources point to two main drivers.
Okay.
First, a sharp improvement in their non-GAAP operating margin. It expanded quite a bit, nearly 2 full percentage points, went from 22.6% up to 24.5%. That suggests they got, dramatically more efficient at turning those sales dollars into actual profit.
Okay, efficiency drive. What's the second driver?
The second one is more financial engineering, you could say, but perfectly legal and effective.
Yeah.
Active share repurchases. Illumina was actively buying back its own stock. They reduced the number of diluted shares outstanding from about 160 million last year down to 154 million this quarter.
Right, so the same amount of profit divided by fewer shares.
Exactly. The earnings per share number automatically goes up. It's simple math, but effective. And just a quick note for you, the listener, whenever you see share count changing like this, you need to understand which measure they're using, basic or diluted EPS. Here, they report diluted, which is actually the more conservative measure. It accounts for things like stock options that could become common stock later.
So the fact they're buying back shares and using the diluted number.
It shows real confidence from management, I think. They likely believe the stock is undervalued, and they're reducing that diluted count aggressively.
Okay, interesting. Let's drill down a bit more into that efficiency story. That seems key. Moving to slide 2, the engine of profitability. First up, let's look at gross margin. Here we actually see a little bit of a squeeze, don't we? The non-GAAP gross margin compressed slightly, went from 70.5% down to 69.2%.
That's right, a slight dip.
So that suggests maybe the cost of actually producing their sequencing machines and the consumables went up a bit relative to prices. Point being, the earnings improvement didn't start right there at the gross profit level.
Exactly. If that first layer profit, the gross profit, actually saw a bit of weakness, then the whole story really has to shift downstream to operational efficiency. And this is where it gets, well, really interesting. The non-GAAP operating margin expanded significantly by 190 basis points. That's almost 2 full percentage points, hitting 24.5%.
Okay, so that's the core mechanism of the beat then.
That's it. They more than made up for that modest compression in gross margin by just, well, running a much tighter ship elsewhere in the business.
But hang on a sec. The sources give specific evidence of that cost discipline, right? Non-GAAP R&D expense fell from $249 million down to $228 million. And non-GAAP SG&A selling general and administrative, that also declined from $268 million to $256 million.
Correct. Clear cost reductions there.
But cutting $21 million in R&D, I mean, for a cutting-edge life sciences company like Illumina, doesn't that sound a bit like they're sacrificing the future for a short-term earnings bump? How do we square that with the confidence they seem to be showing elsewhere, like in their outlook?
That is absolutely the right question to ask. Because, yeah, indiscriminate cutting, especially in R&D, is always dangerous long-term. However, if we look a bit closer, this seems less about, like, abandoning core research and more about focusing resources effectively. When management talks about operational excellence, often it means cutting maybe redundant projects, trimming bureaucratic overhead, optimizing the development cycle, things like that.
So more focused, less cutting everything.
I think so, and cutting unnecessary SG&A costs. Things like maybe excessive sales travel or bloated corporate offices, that's just pure efficiency gain. No one complains about that. Plus, think about it in the context of the raised guidance, which we'll get to. The market seems to be buying this narrative. They seem to accept this R&D reduction as focused discipline, not some kind of panic measure. It suggests they believe their current pipeline is strong enough to handle a slightly leaner, more efficient R&D spend for now.
Okay, that context helps. And just to close the loop on the numbers for this section, the reconciliation between GAAP and non-GAAP, it mainly involved management trying to show that cleaner, recurring business picture, right?
Pretty much. They excluded about $17 million in costs from revenue, mostly stuff like intangible asset amortization from past acquisitions, accounting stuff, and another $20 million in operating expenses related to like transformation initiatives and cleaning up costs from prior deals.
Got it. Filtering out the one-offs and historical accounting hangover to show the current health. Makes sense.
Precisely.
All right, so now we know where the profit improvement came from, that operational efficiency. Let's look at what revenue streams are holding up. Next up is slide 3, the engine room business segment performance. Let's break down the sources of that nearly flat overall revenue. Product revenue, that's their biggest segment, by far, right? Makes up about 85.5% of sales.
Yeah, the vast majority. Instruments and consumables.
That part showed some resilience. It actually grew 1.4% to $927 million. However, the other part, service and other revenue things like instrument service contracts, maintenance agreements, that actually declined 5.4%.
Right. So the slight overall growth is definitely concentrated in selling the boxes and, more importantly, the high-margin consumables that run on them.
Okay, so product sales holding up, services dipping slightly.
But the qualitative context here is, I think, absolutely vital. You can have 1.4% growth, okay, but the quality of that growth matters, maybe more than the quantity sometimes. CEO Jacob Officer, he explicitly stated that the results exceeded their own guidance. And crucially, he said it was driven by revenue acceleration in clinical, our largest market segment.
Revenue acceleration in clinical. Okay, that sounds important.
It really is. This points to a key strategic theme. We could maybe call it clinical as a fortress.
Clinical as a fortress. I like that.
Think about their two main customer bases, broadly speaking. Academic research labs and clinical diagnostics providers. Academic research funding, it's often tied to government grants, things like that. It can be cyclical, sometimes volatile.
Right, funding ebbs and flows.
Exactly. But clinical demand, that's driven by more structural trends, aging populations, the rapid adoption of next-gen sequencing in actual patient care.
Things like cancer testing, prenatal screening.
Precisely. Demand for clinical applications like oncology testing using sequencing to find specific cancer mutations, or NIPT, non-invasive prenatal testing. That demand is strong, it's durable, It's often non-discretionary for patients and doctors.
So less affected by budget cycles, maybe.
Much less. And that steady, robust demand from the clinical side seems to be what allowed that overall 1.4% product growth to happen. It's offsetting any softness they might be seeing in the more volatile academic research sector. The clinical market is basically acting as this defensive, high-reliability foundation for their whole business model right now.
That makes a lot of sense. That high-volume, reliable clinical testing base provides the stability, which then allows them to execute that really tight efficiency strategy we saw in the margins. It connects.
It all ties together, yeah.
Okay, let's shift gears slightly and turn our attention to the balance sheet and what they're doing with their capital. Let's look at slide 4, financial strength and shareholder rewards. So assessing their balance sheet as of September 28th, 2025, how leveraged is this company? Are they running lean? Or are they maybe weighed down by debt?
Yeah, good question. To answer that, we usually look at the debt-to-equity ratio. It's a pretty standard measure. Basically shows how much debt they use compared to the value of equity their shareholders hold.
Okay.
Their total debt that's current plus long-term debt combined is just under $2 billion, about $1,992 million. And their total stockholders' equity is $2,381 million.
So debt is less than equity.
Right. When you divide those numbers, you get a ratio of 0.84.
0.84. And what does that tell us?
Well, generally, a ratio of below 1.0 is considered pretty conservative. It means the company is financed more by shareholder equity than by borrowing from lenders. What this really means for you, the listener, is that the company has a lot of flexibility. If a big acquisition opportunity pops up or if the market takes a downturn, they have plenty of room on their balance sheet. They could borrow more or invest without facing immediate solvency worries.
So a strong foundation.
A very strong conservative foundation, yes.
And they seem to be using that cash and that strong foundation to reward shareholders directly. Tying back to that efficiency we talked about earlier, during the quarter, Illumina repurchased 1.2 million shares of its stock for $120 million.
Yeah, and it's all connected, isn't it? That share buyback is like a tangible demonstration of management's confidence. And as we discussed back in slide 1, it directly contributed to that strong plus 17.5% non-GAAP diluted EPS growth.
Right, fewer shares outstanding.
Exactly. And crucially, they funded this pretty easily. The company generated $284 million in cash just from its operating activities in Q3. So they weren't, funding the buyback by taking on new debt or anything risky. They were using the powerful cash generation from their core business. It's sustainable.
That level of execution, the buybacks, the strong balance sheet, it all signals confidence. Which leads us nicely to the future outlook. Finally, we examine slide 5. The road ahead management's outlook and key takeaways. And management definitely showed some serious momentum here. They raised their full-year fiscal 2025 guidance pretty much across the board. They significantly improved the revenue forecast. Now they expect a constant currency decline of only 1.5% to 0.5%.
Yeah, that's a noticeable improvement from their prior range, which was more pessimistic, forecasting a decline of 2.5% to 1.5%. So a better outlook on revenue.
A significant improvement.
And this wasn't just a tiny tweak either. They also raised the non-GAAP operating margin forecast. And maybe most importantly for investors, they raised the non-GAAP diluted EPS target range from a prior $4.55 up to a new higher range of $4.65, $4.75.
Wow. Raising guidance across the board like that. Revenue, margins, and the final earnings number.
It's a crystal clear signal, isn't it? It tells you the underlying operational trends they're seeing are strengthening. They feel good about the rest of the year.
Okay, so let's try to synthesize everything we've just walked through across these 5 slides. What are the, say, 3 essential takeaways for the listener to really lock in from this Illumina quarter?
Okay, 3 core takeaways. First, that strong earnings beat. It was entirely driven by operational excellence and cost control. Full stop. The reduction in R&D and SG&A expenses proves they can execute a highly disciplined internal strategy, even when top-line revenue growth is slow. They basically manufactured growth through efficiency and not volume.
Efficiency over volume.
Yep.
Got it. What's number 2?
Second, always look past the headlines, especially the GAAP headlines. The non-GAAP results are the true check on operational health here. That alarming GAAP decline was simply a distortion caused by that massive one-time $488 million legal settlement gain from the prior year.
Don't let historical noise confuse the current picture.
Exactly. Don't let it obscure the actual performance today.
And the third takeaway.
Third, management put money where their mouth is. Simple as that. They signaled genuine confidence through pretty aggressive capital allocation, specifically that $120 million share repurchase program. And by raising guidance on every key metric for the rest of the fiscal year, actions speak louder than words.
Yeah, that's pretty compelling. So this structured five-part analysis we just went through, it hopefully provides you, the listener, with a repeatable blueprint way to decode any company's earnings report. It lets you peer past the press release spin and the sometimes confusing technical accounting to find the real story of financial stewardship, even when a company is in a sector facing volatile market headwinds like life sciences has seen.
And maybe just a final thought to leave people with. This raises an important question, I think, particularly for long-term investors, given that Illumina has just shown this really impressive ability to grow earnings purely through internal efficiency and cost management. I mean, turning a tiny 0.4% revenue increase into a massive 17.5% EPS jump. What happens to their profitability picture when market conditions eventually do improve? When those headwinds lift, and maybe revenue growth accelerates beyond this very modest pace?
Question.
That potential combination, continued discipline meeting actual market tailwinds, could unlock some serious operating leverage. Something to think about.
Definitely food for thought. Okay, just a quick note before we wrap up. This report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. Always do your own research. This report was generated by an artificial intelligence model. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.